One of the most common mistakes I see when speaking to investors is people who have bought properties at the wrong time. Buying the property at the wrong time can lead to an underperformance of that property over the first few years of you holding that investment property, or even longer. Behind me, I've got a rough illustration of what a market cycle looks like, or how a property market moves through various cycles. Now, we're very lucky in Australia that each property market can be at a very different point of its own respective property cycle at any given point in time. So there are often opportunities that can be identified and opportunities that can be taken advantage of. But if we were to look at the 30-year performance of any of the major capital cities, we'd likely see a graph that looks something like this. Markets going through periods of growth, periods of stagnation, followed by periods of growth and periods of stagnation. Now, ideally as an investor, we want to be purchasing at these points within those cycles, where we start to see the market moving towards the right direction and starting to move through that growth phase. Unfortunately, a lot of investors get into markets at these points, where our markets become too hot and it's likely to move through a period of decline or even stagnation for a period of 5 to 7 years in some cases. The ways to avoid this is through utilising research. So if you'd like to have a chat to us about the research that we do and the things that we look for, like population growth, infrastructure spending, changes to government policy, market trends, then please reach out and we'd be happy to take you through the areas that we feel are in these points of opportunity right now.